Welcome to The Explainer. You know, if you've ever felt totally overwhelmed by all that crazy market jargon, trust me, you are exactly in the right place. Today, we're pulling some absolutely brilliant insights from the FLA Investment Lab, risk expert Rainer Tio, and FinHabits. We're going to build a really clear, actionable roadmap so you can stop just watching from the sidelines and actually start building wealth. So let's dive right in with a bit of a tough question. Is your saved money just sitting there, totally idle right now? I mean, we all work incredibly hard to earn a living, right? But just leaving a chunk of it completely stagnant in a basic bank account, that literally means you're losing out to inflation every single day. Look, true investing is definitely not some wild gamble or a spin at the casino. The folks over at the Flame Investment Lab define it as a super deliberate strategy. It's simple, really. You just take the savings you aren't spending right now and you deploy them to earn a return. You are basically hiring your money to work just as hard as you do to secure your future goals. To get us there, we are going to follow a clean 5-step roadmap. The need to invest, decoding the stock market, setting up your guardrails, managing your risk, and finally, investing without the panic. Let's kick things off with Section 1, the need to invest. Okay, so the absolute foundation of wealth building comes down to 3 golden rules. Invest early, invest regularly, and invest for the long term. By starting early, you're giving your money the maximum amount of time to compound year after year. It's literally like a giant snowball effect. But it only works if you actually start pushing that snowball down the hill. Now, market swings, they're just a natural breathing pattern. But jumping in and out because you're scared, well, that's going to totally destroy your growth. Actually, listen to this mind-blowing stat from FinHabits. If you miss just the 10 best trading days over a 20-year period, it can cut your entire return in half. Literally in half. So yeah, you absolutely have to stay the course. Moving right along to Section 2, decoding the stock market. Categorizing your options is absolutely key to feeling competent here. The FLM Investment Lab breaks it down perfectly. Basically, if you need cash soon, stick to the short-term stuff like savings accounts, liquid funds, or fixed deposits. But if you're building long-term wealth, that is exactly where things like public provident funds, bonds, and mutual funds come into play. It's all about matching your specific timeline to the right vehicle. Let's clear up some jargon. Think of the primary market kind of like buying a brand new car straight off the factory line. That's where companies issue brand new shares to raise money. But once those shares are actually out in the wild, investors just trade them with each other in the secondary market. It's a lot like buying a used car from your neighbor down the street. So whenever you tap buy on your brokerage app, you are pretty much always operating in the secondary market. All right, on to Section 3, setting up your guardrails. See that number 3? That number literally represents your financial survival. It's the absolute minimum number of months of living expenses you need saved up as an emergency buffer. Let me tell you, absolutely nothing triggers panic selling faster than watching your rent money evaporate during a rough week in the markets. You have got to keep a hard, impenetrable wall between your survival money and your growth money. So let's say your monthly essentials cost about $2,500. Following these steps guarantees you a $7,500 psychological armor against market drops. Just take your rent, your groceries, maybe your minimum debt payments, and multiply that whole shebang by 3. Then keep that money safely tucked away in a bank. That way, if the market crashes, there's no way you'll be forced to sell your stocks at a massive loss just to keep the lights on. Which brings us to Section 4, managing your risk. Now, professional risk management relies on some pretty ironclad rules. Analyst Rainer Tio actually swears by something called the portfolio allocation method. The rule is simple. Never, ever allocate more than 10% of your total account to any single stock. By hard capping it like that, you guarantee that even if one company goes completely bankrupt, literally to zero, 90% of your portfolio survives totally untouched. Let's actually run the numbers on this. Say you have a $3,000 account, your absolute cap is $300 per trade, right? You take that $300 limit, divide it by the stock price, let's say it's $1.50, and boom, you buy exactly 200 shares. There's no guessing, no emotional late-night trades. The math simply dictates the trade for you. Now, if you want a little more flexibility, you can use the 1% method. Here, you decide in advance the exact price where you'll admit, okay, I was wrong, and you sell. That is your stop loss. You then calculate your share size so the total distance between your buy price and your sell price equals exactly 1% of your entire account. So on an $8,000 account, your maximum risk is locked in at just 80 bucks. Period.
But hey, you also have to read the room, right? Rainer Teo points out that in a roaring bull market, you can totally expand that 10% rule to 15% or even 20% just to ride that momentum. But when the market starts crashing into a bear market, that's when you play extreme defense. You shrink your allocation down to maybe 5% per stock or honestly just hold cash. Remember, you control the dial here.
Finally, we arrive at Section 5, Investing Without the Panic.
So instead of constantly hunting for the next big winner, exchange-traded funds, or ETFs, let you just bet on the entire economy. I mean, since most professional managers struggle to beat the market, individual investors really shouldn't be stressing out over picking single stocks. You just buy one ETF, and instantly, you own a tiny fraction of the 500 largest companies. If one of them fails, well, you still got 499 others right there holding up the basket. And this brings us to what I think is the absolute ultimate behavioral hack: dollar cost averaging. By automating a fixed investment, let's just say $200 every 2 weeks, market volatility actually becomes your best friend. You literally don't even have to watch the news. When the market is expensive, your $200 just buys fewer shares. But when everything crashes and goes on a massive sale, your $200 automatically scoops up way more. It completely, 100% removes the panic of trying to time the market. You know, the investors who actually go on to build generational wealth, they are definitely not the ones with crystal balls. They're just the ones who put up solid guardrails, cap their risk with really simple math, and rely on wonderfully boring automated habits like dollar cost averaging into ETFs. You literally have the complete roadmap right in front of you now. So I'll leave you with the only question that really matters. Now that you know exactly how to do it, what is your money going to do tomorrow?